Okay, ladies and gentlemen, we're going to go ahead and get started here. We could close the back door and just want to encourage everybody, if you could, just consider coming up a little bit towards the front here so we can all be part of the conversation together. If Matt was here, he would be much more persistent than I am. So please make me look good and come forward just a little bit so we can be, because these are all better when we participate in the conversation together. So thank you again. This is day 2 of our Catholic Crypto Conference, and for those who were with us yesterday, we had just a tremendous start to our conference, some wonderful and amazing mind-blowing conversations like we just had in the room next door. My name is Jim Friend. I'm the MC for the Intro to Crypto track, so I'll be in this room all morning providing some introductions to our guests. We have a wonderful speaker, Mr. Dan McGlinn, who's going to talk with us about it's an introduction to investing in crypto. So I'm just going to offer a little bit of an intro to Dan. I'm a member of a firm called Changing Our World, and we're a fundraising organization that works with Catholic organizations around the country. I'm also the host of a podcast called Advancing Our Church, where we delve into topics of Catholic stewardship, leadership, and advancement. My wife and I have an online ministry called Kristen's Crosses. And last month, we surpassed 75,000 followers and hit 2 million views in a single month with rosaries and prayer videos that we produce every day and pray with people around the world. So it's great to be in this space and great to be working with all of you. Now on to our speaker, Dan McGlinn. Dan is co-founded and serves as the COO of FirstWatch Crypto and the Windward Fund, a digital asset fund created to help investors gain exposure to cryptocurrencies. He has invested in and studied the digital asset space for 3 years, creating educational content targeting new entrants to the space. He graduated from the University of Notre Dame with a BS in mechanical engineering and a concentration in human-centered design. Please join me in welcoming Mr. Dan McGlinn.
Are we on? All right. Hello, everyone. I'm excited to be here in my bear market red coat. It started day 2. We had a great mass this morning. And I really liked over in the other room, Deacon Bruno said this is the kindergarten classroom. I thought that was really good. And so we're going to keep it simple. Let's look at this from first principles. How are we investing and what is risk? So it's going to be a great day at day 2. But let's talk. The second largest crypto exchange in the world collapsed. They're bankrupt, FTX. There's an acronym for you, Michael. And I'm going to bring this up right off the bat because I know a lot of people are in their seats wondering, what am I doing here? Thank God I haven't been invested in this space yet. And maybe that changed after yesterday, but I have a feeling that a lot of you are wondering that. But really what FTX was a story of greed. It was an offshore, very important, it's not US based, loosely regulated, down in the Bahamas, nobody really knows how they operate, and centralized, owned by a company entity. And other than the funds lost, its collapse eroded a lot of trust, which will take time to rebuild. But FTX was a risk that very few people saw coming, and I want to use that to frame what is risk. What makes something particularly risky? Maybe there's a chance the Eagles don't win the Super Bowl. That's a risk. But what about some more serious things? What about volatility, portfolio volatility? And I really like this example, and Mark Yusko mentioned this yesterday, but he speaks about 1,000 miles an hour, so you might have missed it. But Amazon, generally considered a pretty safe stock, has had a double-digit drawdown every year in its existence, and was down 94% in 1999. Nobody held through that, as Mark said yesterday. It's now down 46%. And Fidelity's recent survey said 59% of institutions, for them, the biggest obstacle of investing is the volatility. They're scared. Bitcoin's way too volatile. But we can look at another example in Apple and say, okay, how many of you have invested in Apple? Anyone? A couple hands. Generally pretty safe. It's done pretty well over the last few months. But it hasn't always been like that. Steve Jobs came in 1997, got rid of the Newton project that was worth $100 million, stocks down 80% from all-time highs. Pretty scary investment. Not many people probably held. If I asked how many people have held it since then, there'd probably be no hands. So Bitcoin has a similarly volatile history. How many of you have thought about investing in Bitcoin or own some Bitcoin? A little bit more hands, not everybody. But I'm not here to convince you to buy Bitcoin. That's not my job. But to understand and frame this in a sense of risk, and more importantly, regardless of your risk profile, how can you make an investment? It's easy to dismiss what we don't understand, chalk it up as too risky, say, hey, I can't make this investment because my portfolio right now is too risky as it is. But we take substantial risks every day in something like Amazon, in something like Apple, in something like walking across the street, trusting our neighbor, and really important foundations for a healthy society. So in 30 minutes, I want to talk about making crypto more approachable for you. How can we, instead of being at 50,000 feet, understanding what these concepts are broadly, how can we lower that to 250 feet, make this approachable, say, hey, how can I understand, given my risk appetite, how can I be exposed to the space? How can I make an investment? How can I understand my risk? So we'll talk about some questions to ask yourself and ways to invest. Oh, sorry, something popped up on here. But yeah, so answering these is why you're here today, why you're in these seats. And I'm happy to extend these conversations further. Afterwards, there'll be contact information on the last slide. Because we want to explore what we think and what many people here think is the most vibrant asset class out there, and it's cryptocurrency. But what is crypto? It's a digital currency based on cryptography on a network distributed across computers. And so what that comes down to is the technology. And plenty of other people, smart minds, have talked about this, so I won't belabor the point, but technology is an enabler. And I like to think back to these arcs of tech adoption based on speed and based on accessibility. How can we get more people to move faster? And a great example of this is transportation. More people moving faster. We had the rail evolve to the car, evolve to air transport, and now we're paying $50 for an extra inch of legroom. More people faster. But similarly, we can look at technology. In mobile, in internet, we could say, hey, internet, we're moving more information and more value faster, digitally, person to person. So I would assume here, everyone here has heard about Bitcoin. And there was a time when Bitcoin was all you had to invest in. This was the only investment you need to make. And if you made that back when that was the case, you've done pretty well. And then Ethereum came along, and you could split your investment, a little bit of Bitcoin, a little bit of Ethereum. But now there's all of these other technologies. A huge amount of this value creation is happening in other spaces. Bitcoin and ETH this morning made up $460 billion of the market cap of crypto. It sits just under $1 trillion. And it's not surprising. There wasn't one company that created the internet. And there'll be quite a few important protocols in blockchains. So how can you structure an investment? Because Mr. Smith, you see online 15,000 different protocols. Go on coinmarketcap.com. You can look at the market cap overall and thousands and thousands of protocols. How do you understand these? You don't want to just throw a dart at an investment and say, hey, here's what we're going to go do. So here's some terms, kind of a broad view of the space. And you have NFTs, non-fungible tokens. You have currency, real-world assets, the metaverse, a lot of topics that we've talked about today, continue to talk about today, and talked about yesterday. So tokens take on different roles in each of these ecosystems, and they go through price cycles. And we've seen that. Different projects rising and falling, huge booms as adoption increases, a new technological breakthrough happens, and huge busts as maybe some of these experiments don't do so well, or collapse, or get hacked, and that happens. But they're building in public is the key thing, and at the end of the day, it is an experiment, and it's moving really fast. But it's about more than just Bitcoin to the moon, we're all gonna be rich. They're building the foundations of the new technology, building this accessible, fast, secure global network. So I ask again, what is risk? And how can you invest according to your needs? There's space for everybody, people of all risk appetites. And I made these a little bigger so you can see, so hopefully everyone can see that. But on the left, you have Bitcoin only. And on the right, you have a highly diversified portfolio, from low activity down at the bottom to high activity at the top. On the left, you have people that are saying, hey, I'm going to buy and hold Bitcoin. This is all I want to do. On the right, you have high-frequency traders, extremely diversified funds, people that might be owning, trading daily, hundreds of different tokens. Most of them are in it for profit. It's a promising strategy and something that's proven very viable. But I'm of the opinion that that blue box is the sweet spot. With all the deployment of blockchain, different projects, it's hard to keep track of. So you want it to be moderately active trading and moderately diversified. As I said, there's 15,000 projects. A lot of those will go to zero. 90% will probably go to zero. But just like the internet was built on a few important companies, blockchain infrastructure is going to be built on a few important protocols. So ask yourself some questions. Do I want a diversified portfolio? I was just with my cousin. He's significantly younger than me, and he's messing around with tokens, buying and selling, doesn't know what these things are, having fun while he's doing it, learning a little bit, which is great. But I said, hey, Johan, you know you can go buy Bitcoin once a week on the Cash App automatically. You don't have to do anything else and be completely hands-off. You don't have to follow the price. You're 19 years old. That's a great way to do it. And his eyes kind of lit up, and he said, oh, like, you mean I don't have to follow this random token name that I have no idea who founded it or what it's about? So that's a bit of the low activity, just a couple asset strategy. And similar to an equities portfolio, another question you can ask is, how close of an eye will I keep on my investments? Do I want to follow this daily? Do I want to track the price? Michael Saylor is a big name in the space, MicroStrategy, and has been a huge believer and a very outspoken proponent of Bitcoin. He says, if you buy Bitcoin, don't look at the price for 4 years. That should be your time horizon. I would tend to agree with that, that you should always take a long-term approach, as we saw with the volatility. So something to consider there as well. And another way you can look at this based on your risk appetite is, do I want to invest in tokens at all? There's so many different avenues to invest. You have mining companies. A lot of these are publicly traded. You have companies that have exposure to Bitcoin. Square is a good example, and I'm not endorsing any companies here. So there's different ways to be exposed to the space without directly buying tokens. You can invest through your 401k. You can ask your financial advisor different methods to do that. So all this to say, there is space for you here. And these are the questions to ask. Like, what are your risks? And for many investors, a hands-off approach has proved the most beneficial. whether through an investment fund or a variety of different avenues that you can use. So here's a few decisions that are tangible, and you can write these down because these are questions that everybody has to ask themselves when they are on the ground level and trying to make an investment. Do you want to be passive or active? Do you want to make a direct or indirect investment? Do you want to be technical? Do you want to go get a hardware wallet, which a hardware wallet is like a ledger. It's been mentioned a couple times, but it's like a USB drive that you can hold your coins, your tokens, offline, put under your pillow, put on your mattress, and it's not accessible by an exchange or a government or any entity. Do you want to invest very broadly across a lot of different tokens, or did you listen to Mark or many others yesterday and say, hey, I only want to buy Bitcoin, I don't want to do anything else? These are questions I can't answer for you, but you can answer and think about. And then a couple solutions here as well. I mentioned hardware wallet. There's private funds out there. There's token trusts. If you want to buy Bitcoin, the Grayscale Investment Trust is out there. And these mining companies, you have Riot Blockchain, some private companies. These are supporting the networks, ways to get exposed to Bitcoin. And some of these companies are ESG friendly. I know there's been a lot of environmental and energy concerns. And they're getting pure Bitcoin directly from the blockchain. So answer some of these questions and you'll have a better idea how you can tackle the space, because what we're here for is how can I understand investment for me in my portfolio. So we've talked a little bit about the macro environment, and this is more crypto specific. But there is a level further down, and this is the particular assets. And this is just as important, especially if you tend to be on the right side of that graph in more diversified investments. And we break these down into 3 different sectors, and you can't read these, but fundamentals on the left, adoption in the middle, and indicators on the right. So fundamentals, what's the token, what's the team, what role does the token play in the ecosystem? If you remember the bubbles on the other screen, these are all different ecosystems moving in different directions, experimenting in different ways. What do I want to be exposed to? And then how does this token play a role in that ecosystem? In the middle, you have adoption, and this is what's the market? Who's working on this project? Who might be inclined to download an app? Why would they be inclined to? And then the third one is indicators. And this is really important. This is what are the risks and how can I evaluate this token? So I want to give a couple examples of these. And again, you probably can't read these, but I'll rattle them off quickly. So fundamentals, you have to ask what it does. You have to know who the team is. You have to understand the token's utility. Adoption, what is the special sauce of the technology? Industry disruption, growth, indicators, you have risks, token dynamics, and ecosystem metrics. And I'll pull out a couple of these specifically. And the first one I want to mention is token utility. What is it used for? Is it used for payments? Bitcoin is used for payments. Stellar is used for payments. And I'm naming a couple tokens here if you can write the names down. Is it used for governance? Crescite, correct me if I'm pronouncing that wrong, but who's here as a sponsor? That's a governance token. Is it used for staking? Raise your hand if you've heard about Ethereum's change to proof of stake. That was a big deal in mid-September when it changed successfully. So that can be used as a staking token, and you can earn yield off of that. That might fit in your portfolio strategy. A second one I would call out is growth. And this is really what our thesis is about. The space isn't going away. I hope that these 2 days make that very clear. But users and developers are at the heart of adoption. where are users going, and what are developers building on. And thankfully, with the blockchain, everything's public, and so we can answer both of those questions. Different routes like Etherscan or all the blockchain data, all the blockchain analytics companies have that information. You can see exactly how many users are on the blockchain, are transacting every day. And you can see the developers that are building these blockchains, what they're building, when they're sending updates. From our perspective, if a blockchain has 5 developers versus 100 developers, it becomes a little more clear the path that they're taking. How many people are behind this? What updates are they making? And is that a little more promising than something that maybe isn't being developed, like Dogecoin, which I know is that people have probably heard about, Elon Musk's big token. But when you look at this fundamentally, there's only a couple people working on that chain. Over the long term, to me, that's not very promising. Another specific one I'd call out is token dynamics. And this one's really important, and I want to use an example of FTX. What FTX was doing with their token is they would back these companies, get all of the token supply, put 1% of that supply out in the market, and the price would go up because people said, oh, this is backed by FTX. At any point, FTX could come out and flood the market with the rest of that supply, the 99% that they held, which would cause the price to crash. And what FTX was doing was at a very extreme end, but a lot of these tokens have ownership by different entities, large ownership, what we call whales in the industry, whales being someone that owns a huge amount of a token. So that's at the far end. A Bitcoin whale owns more than 10,000 Bitcoin. And then you have shrimp that own 0.01 or 0.1 tokens. And so a lot of people like us are shrimps, but there are whales out there, and they have huge wallets that hold tokens that could put this token out and sell at any point. So understanding who these holders are, when they might be incentivized, when they're able to release those tokens or to sell them, is something to consider, and that's a very important consideration. So these tokens support ecosystems, and they're made up of more than one company, like an FTX, and they're made up of more than one person. It's a very diverse space with projects in all of these things that we've talked about, from the metaverse to currency to DAOs that we've talked about these couple days. So hopefully I have a better understanding of investment viability, investment risk, learned about some opportunities to invest, decisions you have to make, and really at a granular level, what makes these projects different, what differentiates these specific assets, and how you might tackle that investment. So I'd love to extend these conversations further. I'll be outside, be available. You can reach me here. If you can't read that, dan@fwcrypto.com, or you can reach me on Twitter as well. But thank you very much.
We have lots of time for questions for Dan. Dan, if you could restate their questions so that the cameras can pick it up. Thanks.
Yes. Jim.
Hi, Dan. I was just reading the Wall Street Journal. I was under the impression FTX was bankrupt, gone, goodbye. But part of FTX is still operating. There's a new CEO, right, and he's looking at the organization. What is the real structure? What is operating and what's not?
Yeah, that's a great question. So he asked what in FTX is still operating. And Jim, obviously the situation is changing every day, so I'll do my best to answer this. But they came out with their bankruptcy filing yesterday. And from the little that I read, the new CEO is a gentleman who has taken part in lots of bankruptcy proceedings. I forget his name off the top of my head. And he came out and basically said, this is the most unqualified, worst business operations that I've ever seen, compared to massive companies based on risk controls and what's happening. So from my understanding, what's going to happen in the future is they will go through bankruptcy proceedings. people will likely not get their money back, and what is being uncovered is more than a failure to repay a loan. It's fraud at a massive scale. He gave himself $1 billion from this company, and then turned around and invested in Sequoia with $500 million. So it's a lot more than simply not returning funds to customers, but fraud at a massive scale. So hope that answers. Yep.
So with FTX being the second largest exchange, that's massive. Yesterday's Wall Street Journal talked about some of the problems at Coinbase, a burn rate of almost $300 million a quarter. Fidelity is now announced that the next month they're going to be selling direct crypto and Ethereum. So for a beginner, is that a safer way to begin putting your toe in the water with direct and personal crypto from Fidelity?
Not financial advice. I'm not a financial planner. However, what I would comment is there are a lot of ways that you can do it, and I would go with what's easiest. And I know for those that were there yesterday, Mark mentioned GBTC, which is the Grayscale Bitcoin Trust. That's out there as well as an option to invest through a 401k or a brokerage account. I'm not fully up to date on that offering from Fidelity, but anything that directly owns, you want custody. You want someone that's holding this custody.
Yeah, they're mining. They've been mining since 2014. They're starting to make it available.
Yeah. So if they have the custody requirements and contracts with the government on being a validated custodian, could be a good option. But again, I'm not sure of the details there.
Let me mic these questions so that everybody can hear and we can record this.
Hello, okay. How do you measure, or what's the easiest way to compare one coin to another by looking at its blockchain? Or how do you determine whether a coin is built on blockchain and whether it's a well-designed blockchain, given that even, Ethereum had to go through some changes to their own coding? So how do you know which coins are, first of all, built on blockchain? Or what's the easiest way to learn that?
Yeah. So there are blockchain scanners out there that you can use to understand where assets are held. And so for Ethereum, this being the second largest, you can go on Etherscan and see all these transactions. You can go under any token, see the largest wallets of that token, and a lot of times those are named. So I can go under Ethereum and see Coinbase, their wallet has this many assets. On-chain, it's represented. So from a user interface perspective, these scanners are the best option. And there are pro users of scanners to really sleuth out. And a lot of what's happening with FTX and a lot of these collapses, you can discover on-chain. That's what you're looking at. So from a purely user interface and just curiosity perspective, I would recommend scanners for Ethereum, Solana, Polygon. They're all out there. Yeah.
Is there a way to invest more at the ground level in blockchain technology? Would that just mean that you're investing in companies that build blockchains, or could you speak a little bit to that, the concept of investing in blockchain technology as a whole?
Yes. So what, blockchain versus tokens? Yeah. Is, okay. Yeah, so I invest and I believe in tokens because they're fundamentally running the blockchains. And that's where I believe value will accrue. But there is the alternative to a lot of VC investment. But companies like Square that's building a blockchain, coming up with some of the hardware that's exposed. So from a purely investing, like a retail investment perspective, that's a great opportunity. These public companies that have some exposure but are not fully blockchain, because the vision of this is we're not interacting with the blockchain every day. We're not on these scanners looking at transactions. It's in the background, and we have a pretty UI that we can use, but in the background behind Visa or IBM, they're running blockchains. And how I see this personally playing out is these companies say, hey, we want to use a blockchain that's existing like Ethereum or Flow or Polygon and build our infrastructure on top of those. So two different ways you can get exposure there is buying investing in the public company that is exploring this, or buying the tokens. So hopefully that answers that. Jim?
Yeah, and I just wanted to ask a follow-on to that. How do you, just a follow-on to that. That was a great question. How do you see the utilitarian side as far as investment, like Corda and, well, to a certain extent, I guess Hyperledger, or companies that are making use of Hyperledger? These they're blockchains, and they have all the use cases all the important use cases that blockchain gives us, the smart contracts, the application, the immutability, but there's no tokens. So they're able to manage transactions for healthcare, for even our ads, right? We see on the Brave browser.
Mm-hmm. So could you say the question?
Oh yeah, just companies like Corda, right? That's a blockchain company, but no token. Companies that build with Hyperledger. Hyperledger is an open source blockchain, enterprise blockchain, but there's no token. So how do you see investment there in those? I mean, there's got to be some type of growth as far as those blockchains.
Yeah, and I'm jealous of the VCs that get into those early rounds of these companies, because frankly, that's how to get exposed to those, or fund of funds that have exposure, like Morgan Creek, like a lot of the blockchain-focused funds like Pantera that have been around for decades now, or Sequoia. So, yeah. Yep.
What does your fund do? What does your company do?
Yes, so we invest in tokens. We have created an investment vehicle that we can say, hey, you as an investor want to get exposed to the space, and we say, hey, we'll give you that exposure to these tokens through a recognizable investment vehicle. We'll do your tax preparation work and give you one form that you can hand to your tax preparer, and make it easy so that you don't have to worry about it. We, as securers of your funds, will keep you updated. We sent out an FTX update to our investors last week, just on the space, so that we take the burden off you from holding something under your pillow in a hardware wallet, and put it on us to manage these funds, stay in the space day to day.
Do you work with financial advisors?
Not at the moment, no, but potential down the road.
Are you open to only retail investors, accredited investors, both, neither?
Both, but all the above, yes.
Thanks.
Yep.
I'm not sure if I missed it, if you mentioned it, but did your company's investments get impacted by the FTX debacle in any way? Did you notice any kind of precipitous fall-offs?
Yeah. I can comment on that for sure, because the whole space was affected, and it was a contagion crypto-wide. And so last week was volatile, to say the least. The crypto news last 2 Mondays ago now came out, and FTX is collapsing and bankrupt. The whole space was affected. We didn't have direct exposure to FTX, didn't have direct exposure to their token. And for those that don't know, so FTX, what they were doing, they have a token, the FTT token, that they were printing themselves and using as collateral. So basically, if you were making money in your backyard and giving loans out and saying, oh, like here's my money that I'm printing, it doesn't work. It doesn't make logical sense. But that's what they were doing with their FTT token. Yep.
I just was reading that a number of the spokespeople for FTX have been personally sued because of their equity shares and their brand deals with FTX and the advertisements they did. Some of the criticisms that have been made about people like Tom Brady and Steph Curry is that they have access to the greatest legal and finance teams in the world, yet they didn't seem to find anything wrong or unusual with the way FTX was operating. And a lot of people probably think they should have noticed that. Is there a reason that this was so well hidden from your average savvy financial investor?
I can make a quick comment on that, and they're investing in a company that they believe in, and so they're going to promote it. If Tom Brady's he was an angel investor, he and Giselle, they're going to promote that. No, if they even FTX got audited, no auditor is going to find a backdoor that's built so that an auditor doesn't find it. And that's what was happening. It was fraud at a massive scale, and if they're going to try to hide that fraud and be as deceptive as possible, it's not going to be found. And so if you have Tom Brady, if you have these high-profile lawyers, are they going to find it? Not necessarily. And you can read some of the reports from Sequoia about their initial interactions with Sam Bankman-Fried and the face he was putting on, and it was promising. People really believed in it and believed in the space, and so we're seeing the repercussions of that, and people will tiptoe in a little bit more carefully, obviously. Got two here.
Where did your firm custody its assets?
So we can talk more in depth afterwards for specifics about us, just because of restrictions that we have. Yeah. Sorry.
Thanks. Thank you for the talk so far. My question is precisely with regards to the risk we're seeing, FTX collapsing like this. How can we, as small-time investors, protect ourselves against potential future built-in backdoors meant to escape regulators? How is that anything we could possibly comprehend, linking on to the previous question? And doesn't that sort of make us go in blind to a context in which we don't really see what's going on? Even if we really are relative experts, how can we possibly catch stuff if even the regulators aren't?
Yeah, that's a great question. And I would frame it as, what is risk? The cost of being an early adopter is facing things like volatility, things like these collapses, because all those bubbles on the screen are all doing their own thing, deploying this in different ways. Never put in so much that if it goes away, that you're in a tough spot financially. And so that'd be my advice, that this is being built from the ground up. There will be mistakes made. There are bad actors that can take advantage. So if whatever for you personally, you can sleep well at night, is what you should do. Because yes, things could collapse, things could go away, but the technology's there, Bitcoin's not going away. So whatever you take from that, whether it's a hardware wallet or not using a regulated US-based entity as your exchange, like a public company like Coinbase, whatever, for you, for your risk appetite, and for the amount of money you want to put in, that'd be the response.
Well, that's about all the time we have for questions. Another big round of applause for Dan McGlinn. Thank you. Dan, great job.